What are the advantages of minimum pricing? If we base our selling prices just on relevant or incremental costs, what is the benefit of doing that? The first benefit, guys, is it distinguishes between relevant and irrelevant costs. And we saw when we did the calculation, we only took incremental cash flows or relevant cash flows into account. So we can clearly see what's relevant and what's not relevant. So it helps for decision-making purposes. Then opportunity costs are incorporated into the analysis. So guys, if by accepting this special order over here, we had to sacrifice some of my normal sales, then I would have to add an opportunity cost to this calculation. And you would do it in exactly the same way as we calculated our opportunity cost in the previous example. So remember, if they did tell you by accepting the special order, the company has to sacrifice 2,000 units of their normal sales, then please note you would definitely have to add an opportunity cost to this calculation over here when you're working out your minimum price. Okay, so opportunity costs are incorporated into the calculation, which means the company is compensated for any lost contribution on their normal sales. Okay, they are compensated for lost contribution. Then the third advantage is it gives us information to enable tenders to be made at more competitive prices. So if we are dealing with a very competitive environment and there's a lot of companies that are trying to tender for exactly the same special order, remember, if you look at your calculation, the cost that we calculated for decision-making purposes in order to only cover my relevant cost was 11,500 Rand, and my cost for accounting purposes is 17,500. So costing using minimum pricing or relevant costing ensures more competitive prices because we only take relevant costs into account instead of our total accounting costs. What are the limitations of minimum pricing or relevant costing? Firstly, guys, it is a cost-based method, meaning that I'm determining my selling price based on what the product is going to cost me to make, and I don't take demand into account. What I actually should do if I'm trying to determine a selling price for a product, I should always consider the demand for that product because the demand should have an impact on my final selling price. But when we do our calculation like this, we completely ignore demand. We only look at costs. There's difficulty in determining opportunity costs because information on all available opportunities may not be known. So I said to you just above that one of the benefits of minimum pricing is we include opportunity costs into our calculation. But if we don't know the different alternatives or the other opportunities that the company has at its disposal, we can't take that into account. So some opportunities are not known, and if those opportunities are not known, then it will be difficult to determine what the opportunity cost is. And then the last limitation of minimum pricing is there is a danger that customers will expect repeat business at this lowest selling price. Okay, so we must be careful. This lowest selling price where we only cover our incremental costs, I said to you, this is not for the company's normal sales. Because remember, with the company's normal sales, we also need to cover our fixed costs. With special orders or once-off orders, we don't have to worry about covering our fixed costs. We only worry about covering our incremental costs. And it's fine if this is just a one-time order, but you don't want the customer to think that repeat orders will be at this low price. If the customer wants to order again and it's not just going to be a once-off order, it then becomes part of the company's normal sales, then we can't only cover our incremental costs. Then the company needs to make sure that they cover their full cost, their variable and all of their fixed costs. So you can see care must be taken to ensure that negotiating special one-off contracts does not affect the demand for other products. And you can see just below, relevant or minimum pricing is more appropriate for short-term, once-off pricing decisions. So that's what I said to you. Normal sales cannot be at this lower price. my normal sales must also cover my fixed costs, or else the company is always going to operate at a loss. So my normal sales, I cover all of my costs. Once off special orders, I only need to cover incremental costs. And we're going to look at our normal sales just below. So you can see, let's actually discuss this while we are still here with your normal sales. In the long term, it's important that the company covers all of their costs and they make a profit on top of that. They can't only cover their incremental costs in the long term, because then the company will actually operate at a loss. So guys, relevant or minimum pricing is fine for once-off pricing decisions, special orders, etc. It's also appropriate where the company has unutilized capacity, because guys, if the company has unutilized capacity, that means they have spare capacity. So in our example previously, we also saw the company had some spare capacity. If you have spare capacity, normally there's no change in your fixed costs, because you have spare capacity. You can still make more units in the existing factory using the existing machine. So there's no changes in your fixed costs. So you don't have to worry about covering any fixed costs. You just have to worry about covering any incremental costs. So it's normally your variable costs are incremental. If there is any change in the fixed costs, we did see in our calculations, we took that into account. So we always just covered our incremental costs. And it's also appropriate where we can sell at different prices in different markets. So what I mean is, if we have a special order over here and we're prepared to sell at a lower price to one customer, you don't want other customers to hear about that, because then they're going to get upset and they are also going to demand the lower price. So it is possible to do this where you are dealing with different markets, because then you can sell at different prices to different markets and your customers are not aware. However, if you are selling to customers all in the same market, you then can't charge different prices, because the customers that are paying the higher price, your normal customers that normally order from you, are going to be upset that somebody else managed to get a special price. Okay, and they are also obviously going to want that special price. All right, so let's now look at long-run pricing decisions. So we've touched on it already. I said these are the company's normal sales. So if it's the normal sales, we can't just cover incremental costs. We need to make sure we cover all of our costs so that we can still have a profit. And the reason for this is because we are now looking at long-term decision making. A once-off special order is a short-term decision. And in the short term, relevant costs are different to relevant costs in the long term. In the long term, my fixed costs can also become relevant. And the reason for that is because in the long term, it's possible for companies to adjust their capacity and therefore adjust their spending on fixed costs. In the long term, I can hire new premises, or I can downscale and I can reduce my capacity by selling off machines that I'm not currently using, etc. So in the short term, my fixed costs are not relevant, because in the short term, I can't adjust my capacity. However, in the long term, my fixed costs become relevant, because in the long term, I can adjust my capacity. And if I can adjust my capacity and I can avoid my fixed cost, it is then relevant. Go back to your general rule. If a cost can be avoided, it's relevant. And in the long term, we can avoid our fixed costs because we can adjust the capacity of the factory. We can hire more space. We can reduce the amount of space that we are hiring. We can buy new machines. We can sell machines we're not using, etc. So in the long term, we can adjust capacity. In the long term, fixed costs are therefore relevant because they are avoidable. In the short term, we can't. In the short term, we have to incur that fixed cost no matter what we do. So in the short term, it is not avoidable, so it is not relevant. So I'm just going to add that actually if we go back. In the long run, my fixed costs become avoidable, so they are relevant. In the short term, when we are dealing with once-off special orders in the short term, my fixed costs are not avoidable. And if they are not avoidable, they are not relevant. Right, so that's the difference between the two. First, we looked at once-off orders, so short-term decision making. Now we are looking at the company's normal sales or long-term decision making. So what do we need to take into account when we are trying to determine the selling price for my normal sales? First, we need to consider whether the organization is a price taker or a price setter. Now, a price taker means that the organization does not have any influence over the selling price of the product. So that normally happens where there are many different suppliers of similar products. So you can't say I'm going to charge 200 Rand for a roll of toilet paper, because customers will never buy your toilet paper no matter how fantastic it is, because you can get really good toilet paper at a much cheaper price. So if you are selling toilet paper, you are a price taker, and you can't just set the price as to whatever you want. There are many suppliers selling exactly the same product, so the value is actually determined by supply and demand, and you have to then price your product based on supply and demand, and you do not price your product with reference to what it costs you to manufacture it. So it might cost you 200 Rand to make the toilet paper because maybe you are using very fancy material. However, you can't look at the cost when you're determining your selling price, because there are many suppliers of toilet paper. Customers will not buy your product. You are a price taker, and the price is actually set based on supply and demand. Okay. However, what is important, if you are a price taker, you need to do a profitability analysis to make sure that you are only selling profitable products. So you are not in control of what your selling price is. The market determines the selling price. However, if you calculate that you're making a loss, so your costs are more than what you can sell the product for, then you should discontinue the product. You should only sell products that are actually profitable. You can't change the selling price, but you can decide not to sell the product if it's not profitable. On the other hand, guys, if the organization is a price setter, that means they do have an influence or a say in what they price their product at. So you can see the products then are obviously going to be unique or customized, and there are not a lot of suppliers of similar products, so there can't be a lot of substitute products. And if you have a very unique or customized product, then you will have some discretion in setting the selling price. And normally then what happens, if the company has to determine what their selling price must be, they are going to use the cost as a basis for determining their selling price. So first they identify, what does it cost me to make this product? I'm then going to add a markup to that so that I can get my selling price. They are price setters, and they set their price in relation to what it costs them to make the product. Price takers cannot do that, so they just have to make sure that their costs are lower than the selling price and the product is actually profitable. All right, so if the company is a price setter and they use the cost in order to determine their selling price, what are the advantages of using cost plus pricing? So I'm using the cost in order to determine my final selling price. The first advantage, guys, is it's very simple, which means the task can be delegated to lower level employees or junior management. It doesn't have to be done by high level management. It's not a complex decision. We determine our cost, and if the company says we apply a markup of 20%, junior management can then easily work out what they should sell the product for. In addition to that, it can be seen as a way of justifying prices and price increases. So if a customer complains about the price of a product, the organization can always justify why they're charging that, because it's based on the cost. The company can say, well, listen, the price actually isn't excessive. This is what it costs me to make the product. I'm only adding a markup of 20% to get my selling price. So they use it as a way to justify selling prices. Then also, guys, we can vary markups between different products and customers depending on the market conditions. So if we sell lots of different products, not all of them have to have a markup of 20%. We can change the markup depending on what we think we should sell the product for. We can also change it depending on the customer, if we are dealing with customers in different markets. Okay, but that can only be done if we're dealing with customers in different markets. If the customers are all in the same market, you're forced to sell at the same selling price. And the last benefit over here is that if our prices are based on full cost, then it ensures that the company covers all of their fixed costs and they still earn a profit. So we take the full cost of the company, we add a markup, and we get our selling price. And by doing that, we make sure the company covers all of their costs and they still make a profit. What are the disadvantages of cost plus pricing? The first disadvantage is we do not recognize that there's a relationship between the price charged and the quantity sold. So it fails to recognize the relationship between the price and the quantity sold. So the example that I want to give you guys over here about how this can be so dangerous. Let's say that the fixed costs of our company are 100,000 Rand. If we produce 10,000 units, my fixed cost per unit is obviously going to be 10 Rand. However, if I produce 8,000 units, then that cost of 100,000 Rand is being spread over fewer units. Instead of splitting the 100,000 Rand over 10,000 units, the price is being shared between 8,000 units, which means my unit cost is going to increase to 12.50 Rand. So you can see just below, if demand is falling, so if demand drops from 10,000 units to 8,000 units, the firm is going to have to increase their cost per unit so that they can cover their fixed costs. Because if they sell more units, they only need to cover fixed costs of 10 Rand a unit. However, if demand drops, they need to increase their price so that they can cover their fixed costs. And they need to increase it to 12.50 Rand per unit in order to cover the fixed costs. Now, obviously, if we are working out our selling price based on our cost, so if we're taking the cost and we are adding a markup in order to determine our selling price, the problem is now when my cost increases, my selling price is also going to increase. And the problem with that is if my selling price increases, demand is going to drop. And this is then just a vicious cycle, because as my demand keeps dropping, my cost per unit is going to keep increasing, which is going to further cause demand to drop. Okay, so that's obviously a problem. Another problem of using cost plus pricing is the price charged by competitors is completely ignored. When we determine our price, we take our cost, we add a markup, and we get our selling price. We don't look at what competitors are doing. So obviously, guys, if it's a very competitive environment, the problem with doing that is you could outprice yourself and customers will rather buy the product from a cheaper supplier. The next disadvantage is if we use traditional costing. Now, again, this is based on knowledge that we've covered in previous topics. Remember, we've looked at traditional costing and we've looked at activity-based costing. With traditional costing, overheads are allocated to our products using an arbitrary basis. That's where we use traditional costing. However, with activity-based costing, obviously we have a lot more accurate costing of our products because it wasn't an arbitrary basis. We used cost drivers where there's a cause and effect relationship. So remember that. There's a bit of revision over here. So the problem is if I'm using traditional costing, so an arbitrary way to allocate my overheads, my products aren't going to be costed correctly, which means I'm also going to have arbitrary selling prices because I'm going to use that cost as a basis to determine my selling price. So if the cost is incorrect, the selling price is going to be incorrect. So obviously it is much better if the company can use activity-based costing because then the product will be more accurately costed, which means we'll have a fairer selling price. The last disadvantage of cost plus pricing is it can lead to a complacent attitude towards cost control. So the organization doesn't focus on trying to control their costs because if costs increase, they just pass that increase on to the customer. They're not worried about controlling their costs. And the problem with that is it's obviously very dangerous in a competitive environment because if costs just keep increasing and you don't control those costs, your prices are just going to keep increasing. And if competitors are controlling their costs better, they will have better selling prices and you will lose customers to the competition. Then the last thing that we need to look at under this section is how does the company determine what markup to apply? How do they determine the size of the markup? Is it a 10% markup, a 20% markup, a 30% markup, etc.? What are the things that influence that decision? So the first thing that influences the decision is the demand for the product. Obviously, if demand for the product is high, then they will be able to have a higher markup. And similarly, if demand is lower, then your markup is going to have to be lower. The level of competition or the amount of competition will also affect the markup. If there is a lot of competition, then your markup is going to have to be smaller. Whereas if there isn't a lot of competition and you've got quite a unique product, you'll be able to have a larger markup. So markups are likely to decrease where competition is intensive. It then also depends on the nature of the product that we are dealing with. Is it a luxury product or is it a necessity? If it is a luxury product, you'll find if you change the price even by a small amount, so small changes in the selling price of our product will lead to customers changing their spending habits quickly and moving across to competitors very quickly. Because it is a luxury item, remember, they can go without. So even small increases in the price of luxury items could have a very big impact on demand. Okay, and that's known as your demand being very elastic. A small change in the price will have a big impact on the demand for the product. Whereas on the other hand, if we are dealing with necessities like toilet paper or toothpaste, then you'll find that a change in the price of the product doesn't necessarily affect the demand. So the demand is then inelastic. So even if we change the price of the product, demand does not change significantly. And that's because we are dealing with necessities and people still need to buy those products. So even if prices change, you still have to buy the product. Then the last thing that can affect the markup is the pricing policy or the pricing strategy that the company has. Are they going for a price skimming strategy or are they going for a penetration pricing policy? Now, price skimming means when you first enter the market with your product, you enter with a very high price, and what you're trying to do is take advantage of a novelty appeal of a new product. So this is when you obviously have a unique product, a unique new product. So when iPads were first released, or tablets, when tablets first came out into the market, they were very expensive. They are still expensive, but the prices have come down. So what happened is because it was a novelty product, it was a new product, when they entered the market, they came in with very high prices. Then once the market was saturated, the price is later reduced so that we can attract the part of the market that has not yet been exploited. So you'll see now the price of tablets has come down and a lot more people can afford to buy tablets. So that's referred to as price skimming. A penetration policy is when you first enter, you enter with a very low price. So what you're trying to do is you're not going to make money through your markup because you're entering with a very low price. Instead, you're trying to make money through higher volumes. Okay, so with price skimming, you're making your money through your markup because initially you have very low sales volumes, but your markup is very high. So that's how you make your profit. With the penetration policy, how you're making your money is through sales volumes. Because you come in with a low price, so you have a low markup, and you're making money by selling a lot of units. So with the penetration pricing policy, low prices are charged initially, and the whole point of doing that is trying to gain rapid acceptance of the product because it's cheap, so a lot of people will buy it. And another thing is it will discourage competitors from entering the market because of the fact that the price is so low and they might not be able to compete with you, which will give the company time to establish a large market share. Okay, so the markup depends on the demand, it depends on the level of competition, it depends on the nature of the product we are dealing with, and it depends on the pricing strategy of the company. Then we just need to look at an example so that you guys understand the difference between a markup and a margin. Now, this is extremely important. Let's look at two different examples. I've given you the cost of product A, and I tell you that the product costs me 100 Rand. And I want you to calculate the selling price, assuming that we have a markup of 20% on cost. Now, what's very important to understand is when we are dealing with a markup A markup is always based on the cost price of the product, which means we make the cost 100%, we add the markup of 20%, and that will give me a selling price of 120%. So if I now want to work backwards, I know what the cost of the product is. The cost of the product is 100 Rand. The cost is 100%. I want the selling price. The required wants me to calculate the selling price. So I'm going to have to multiply by 120 and divide by 100. So that's what I'm doing in my calculation over there. The mathematical logic behind this is you always multiply by what you want and you divide by what you've got. I want the selling price, so I'll multiply by 120%. What do I have? I've got the cost, so I divide by 100%. So it gives me a selling price of 120 Rand. And you can see that is a markup based on cost. They've taken the cost of 100 Rand, they've added a markup of 20%, so that will be 20 Rand. So my cost is 100 Rand, we add a markup of 20%, giving me a selling price of 120 Rand. It is a markup which is based on the cost of the product. A margin is completely different, guys, because a margin is based on sales, not based on cost. So I give you the same information. The cost of product A is still 100 Rand, but now I want you to calculate the selling price, assuming that we have a margin of 20% on sales. So not a markup of 20%, a margin of 20%. Now, when the markup was based on cost, we made the cost 100%. So markup based on cost, make cost 100%. A margin is based on sales, which means I make my sales 100%. My margin is 20%. So if I work backwards, that means my cost must be 80%. And applying exactly the same mathematical logic, I have the cost of 100 Rand. I need to multiply by what I want, and I divide by what I've got. What do I want? I want the selling price, so I multiply by 100%. What have I got? I've got the cost, so I divide by 80%. And that then gives me a selling price of 125 Rand per unit. So you can see it's very important that you read the question correctly, because a markup is completely different to a margin. If it is a markup, my selling price was 120 Rand, whereas if it's a margin, my selling price is 125 Rand. So it has a completely different effect on your calculation. Make sure you read properly. Then one last thing just to wrap up this section, guys, an alternative, instead of using cost plus pricing, so we've looked at cost plus pricing. We looked at the advantages of cost plus pricing, the disadvantages. We looked at how we determine how big that markup should be. We've looked at all of that. Instead of using cost plus pricing, so instead of taking my cost and adding a markup in order to get my selling price, companies instead might choose to use target costing. And with target costing, we work backwards. First, we determine what our target selling price should be. And the target selling price is determined based on what the market is prepared to pay for the product. So we look at our customers, we look at what competitors are charging, we look at external information, and based on that, we make sure we price our product competitively. So we set a target selling price which is competitive. And then we work backwards. Once we know what the selling price must be, we deduct the profit that we want. So management might say we want a profit of 20% or 30%, whatever it is. They deduct the profit that they want from that selling price, and then they get to their target cost. So you can see that in the paragraph above. First, what we do is we get our target selling price. Then we deduct the desired profit margin so that we can get our target cost. And the target cost is ideally what it should cost us to make the product. It isn't necessarily the actual cost. So what the company is going to have to do is they are going to have to compare this target cost to their actual cost. And the aim is to then try and ensure that the actual cost is not higher than the target cost. If this actual cost is greater than the target cost, then the company is going to have to go through cost-cutting exercises so that they can close this gap. So what happens if we work out our target cost must be 80 Rand and we see we're sitting with an actual cost of 100 Rand? The company is going to have to find out how they can cut their costs in order to come down to a target cost of 80 Rand. And this is obviously much better than saying, what is my cost, add a markup to get my selling price? Because now I'm not just looking at a random selling price without taking external factors into account. My selling price is now a competitive selling price because it's set based on what competitors are charging and what customers are prepared to pay for our product.